Hey there, this is Casey Lamb, Strategic Mortgage Solutions, here for the Tuesday Mortgage Talk. If you've tuned in and watched some of the videos I've done before, you might have seen one about a month ago that I did. It was talked about, basically what I talked about was one of the unsung benefits of home ownership, which is cash flow as it is compared to rent versus own. You see, about a month ago, what I talked about was essentially how one of the primary benefits that people talk about financially about owning a home is the simple fact that you get to buy a house and eventually at said price, and eventually when you go to sell that house, you sell it for more than what you paid for it. A lot of people don't really look at the benefit standpoint of cash flow of rent versus own. I have recently subscribed to a really neat tool that helps me further exemplify and visually show the benefit of home ownership from a cash flow standpoint. In this particular scenario that I ran, you can see here on my screen, we're examining the scenario of somebody renting a home for $1,600 a month, paying $22 a month for renter's insurance. And if you don't have renter's insurance, you should. Your landlord's not going to protect you in case of a fire on your own personal possessions. And the other thing is, if we put in the assumption that the cost of rent will go up 4.5% annually. Now, I didn't just make this number up. I actually examined rental statistics throughout, the state of Oregon, and over the last 3 years, we've seen rental appreciation actually average over 4.5%, but I think things are going to moderate a little bit. I mean, if you unless you've had your head stuck under a rock, you probably have read articles, seen things online about rent controls that have been invoked throughout the state of Oregon by our legislators. The new rental laws cap landlords on increasing rent by no more than 10%. Now, there are a lot of other protection mechanisms in there to protect tenants from adverse rent gouging and so forth, and evictions and so on from landlords that want to profiteer in this kind of competitive market. But essentially, if we use 4.5%, I think it's a safe assumption. Realistically, they're still not building enough single-family homes. They're still not building enough townhomes, multifamily homes to keep up with the current housing formation, as we like to call it, where households are formed and move out into their own sort of homes. And in fact, there's a backlog that goes back almost 10 years. So they've been underbuilding for so long that's really driven up rents, and it's probably why the state of Oregon had put in some rent controls into place. But that said, we also compared that to buying a house, $275,000, putting 5% down, property taxes right around $3,000 a year, home insurance $60 a month, $720 a year, and made some assumptions as far as how much the cost of tax insurance are going to go up annually. We assumed right around 2.5% on that, which is a statistical average. Now, get this: when you buy a house, you have a majority of your payment made up of principal and interest. And if you get a 30-year fixed loan or a 15-year fixed loan, if you will, you are locking in as the majority of your housing payment for the life of that loan, meaning they can't change so long as you're making your payments on time. And because of that, over time, in comparison to rent, it's very evident that the benefits of owning a home significantly outweigh renting just from a cash flow standpoint. And you can see that here as you break it down up here. Look at the top right-hand corner of this shared screen. Now, you'll see here that the monthly PITI in the first year of owning a home is right around $1,791 versus renting, with renter's insurance adding up to about $1,622. Notice the dark blue for buying and owning versus renting in purple. Now take a look here. Initially in this bar graph, you'll see here how the cost of owning a home, is essentially a bit higher than renting. This is strictly cash flow. This isn't even talking about the benefits of having some of your payment go towards amortization. We'll get to that in a little bit. But over time, look how by year 4, renting has almost caught up to the cost of owning, just from a standpoint of one payment versus the other. Then, after year 4, going into year 5, renting starts to exceed the cost of owning. And look how it accelerates over time by year 10, year 13, year 15. Now, by the year 15, a person is paying almost $3,000 to rent versus their house payment, which is right around $1,900 a month. Now, over a course of 15 years, that's a difference of $71,794 in total cash flow. Now, people don't, people just, $71,000 kind of sounds like a lot of money. It is, of course, and over 15 years, that's kind of an impressive statistic. But think about this: if you're a homeowner now who has a 401k plan, or where their employer matches, maybe initially in the first few years of home ownership, that homeowner might not necessarily have the extra cash flow to really fully contribute in a 401k. Hey, maybe they do, I don't know. But over time, as a person continues to get more raises, but their cost of making that payment on a house doesn't budge much from year to year basis in comparison to rent, there's a great opportunity for that homeowner to redivest their improved cash flow year over year to other opportunities, such as their 401k plan. Hey, what if they could get a match that and fully invest into their 401k, put that money to work in something that has an opportunity to grow? That's where I believe being a homeowner financially is one of the bigger benefits. Of course, there are other measurements that you can also consider. In this illustration, the other thing that's kind of cool is that this also takes into account home appreciation, which in our county has been averaging around 5.48% historically, and actually a little bit more historically, but the forecast going forward is right around 5.48%. So over that 15-year period, from the price of buying a house at $275, eventually the house is going to go up in value, and at 5.48%, 15 years down the line, that home will have appreciated by $337,000. The other thing that's cool about this, even though we're talking about cash flow, part of the component of a house payment is principal, money that is put to paying down the balance of the loan. Over the course of the first 15 years, a homeowner will have paid in principal $92,632. Essentially, think of it like a forced savings account. If and when they ever decide to sell, they also have that amount of principal that they've paid down. And when you think about it from that standpoint, you add up the potential net gain to a home buyer just in terms of appreciation and the principal reduction that they've paid. If they just made the minimum 30-year fixed mortgage payment in the first 15 years, you're talking about $462,000 of additional benefit that a renter just doesn't get. In addition to that, a renter also over time is going to pay more for their housing than they otherwise would with buying. And this also takes into account about $120 a month of actual maintenance cost that a homeowner might potentially pay on average, month after month, year after year. So if you're considering the idea of buying a house and you're on the fence, or you're a financial planner, a realtor, or some type of advisor for somebody considering the idea of buying, this is a great reference point to show somebody the long-term intrinsic benefit of owning a home from a financial standpoint. Not just the warm and fuzzies, but cold hard cash. This is Casey with Strategic Mortgage Solutions. Have a great day.